Now let's look at managing cash. Now, when we're looking at managing cash, as with everything to do with working capital management, it's a balancing act. We know that we need cash. Without cash, we will fail as a company. We need to be solvent. But the issue is we don't want too much cash, because cash is an idle asset. We know it costs money to fund the cash that we hold, and we generate no return from it. So, given the balancing act, again, we need enough, but not too much. Now, if we're looking at cash management, there are three areas that we may look at. One is the Miller-Orr model. The Miller-Orr model focuses on establishing what sort of balance of cash we should be looking to hold in order to do precisely that balancing act. Make sure we have enough so that we don't run out, but again, do not have excessive amounts. It does this in an environment of uncertainty, which is probably reflective of real life. The idea that on any given day, we don't know whether there will be a cash inflow or an outflow. We also have the Baumol model. The Baumol model is the EOQ model used for cash balances. The idea behind Baumol is this. The company is either cash generative or a cash user. That means that if it was generating cash and we did nothing, the cash balance would progressively rise. Of course, we don't want lots of cash sloshing about in the business. So what we're looking at here is this. If the cash balance is progressively to rise, how often do we take money out of the cash balance and invest it elsewhere? So a very simple idea comes up on occasion. I think it's the third area that could be some people's Achilles heel. The cash budget. The reason why I say that is this. You see, the cash budget comes up on a semi-regular basis. But when it comes up, it has the potential to come up for half the marks in one question, or more. And if that's the case, you must know how to deal with it. You cannot avoid doing the cash budget and still get a solid mark in the exam. So, when we look at the cash budget, we're going to look at a very comprehensive example, maybe more comprehensive than you would expect in the exam, to look at all the details that may arise. But the first thing we're going to look at is to consider the Miller-Orr model. When we look at the Miller-Orr model, all we're looking at here is that we have control limits. Control limits for cash. You see, the basic principle goes something like this. We cannot micromanage cash because we know the cash balance is going to go up and down. As such, what we want to do is to establish some very basic limits, a lower limit and an upper limit. If the cash balance is between those two limits, we take no action. If, however, we hit the lower limit, that suggests we've got too little, and so we introduce more cash. If it hits the upper limit, that means we've got too much, and therefore we take some cash out and invest it elsewhere. So, if we're looking at it, maybe what we could do is just illustrate what it is that we're trying to calculate. If we were looking at plotting over time our cash balance, the idea behind Miller-Orr is that we establish a lower level and an upper level, if you wish. A lower limit, you could call this a minimum level, or an upper limit. Now, the lower limit is nothing to do with Miller-Orr. You will have to be given that by some other means. all we want to do with Miller-Orr is to understand the difference between the lower and the upper limit. This difference is called the spread. And this is the range over which we are willing to allow cash to fluctuate. If it goes above the upper limit or below the lower limit, we must take a control action. Now, the third thing that we have to be aware of is something called the return point. And maybe the best thing to do to illustrate how this works is just to suggest what would happen on a daily basis. So here's our cash balance bouncing up and down. It happens to hit the upper limit. If it hits the upper limit, we've got too much cash. So what we do is we take out the difference between the upper limit and the return point. We take that out and invest it in short-term securities. And then we let the cash balance loose again. So it starts bouncing up and down. Notice, if it's bouncing up and down within the range, no action is taken. But if we hit the lower limit, what we see is that we've got too little cash, and therefore we encash any of the investments we've already made, encash them, get the cash out of them, and bring that money back in. So we are again at the return point. Now, the deal is this. The distance between the return point and the upper limit is 2/3 of the spread. And the distance between the return point and the lower limit is 1/3 of the spread. I've read the model, I've looked at what Miller-Orr had to say, and there's no logic to this, but I suppose there are some basic ideas. You know, the idea that we would rather have a lower limit than a higher limit, therefore only encash 1/3, and maybe the argument could be that a lot of companies are basically cash generative. And from that perspective, we would expect the balance of cash to rise rather than fall over time. So, that's the way the Miller-Orr model works. And all we have to do is to establish these control limits. And in order to do that, very nicely indeed, all we really have to focus on is calculating the spread. Now, the spread formula is given to you in the exam, so you don't have to get excited about it. But we best write it up just to make sure that we understand the tricky parts about it. You see, the spread is quite an interesting formula. 3 multiplied by open bracket 3/4 multiplied by the transaction cost multiplied by the variance of the cash flows divided through by the interest rate or to the power 1/3. Right, okay. First things first, the transaction cost is the cost of either investing or encashing the money. You know, every time we take money out of the bank account and put it in short-term securities or vice versa. When we look at the variance, well, this is nothing to do with something adverse or favourable. Remember we said that Miller-Orr is about uncertainty. We don't know what's going to happen. And variance is a measure of dispersion. I don't know if you remember this idea. One key measure of dispersion was the standard deviation. And all we need to know is this: the variance is the standard deviation squared. Okay? You may remember that from your studies. But if you didn't, please remember it, because in the pilot paper, your examiner gave you the standard deviation rather than the variance. You had to remember to square it to get the number that you wanted. The other thing that's of interest here is the interest rate itself. You see, the whole point about Miller-Orr is that we are looking at things on a daily basis. So we're not looking at it per month or per annum. We want the interest rate per day. Now, the whole point about the interest rate being per day means that we expect it to be a small number, a very small number. 10% spread over 365 days is going to be really quite small. So, with those 2 points in mind, let's just think of a little Mickey Mouse example. You have to be given the minimum level. Let's say the minimum level is $25,000. Yes? This is nothing to do with Miller-Orr. It will always be given. The transaction cost equals $50 per transaction. You know every time you encash or invest money. The variance is $250,000. Now, please note, you could have been given this as the standard deviation equals 500. Yeah? And it would mean the same thing, wouldn't it? So please be ready for that one. And finally, the daily interest rate equals 0.05%. So, okay, this is not going to be rocket science. We can do this, but too many people get this wrong. So let's just take it nice and slowly. If we're looking at our spread, we know we're going to take 3 multiplied by 3/4 multiplied by $50 multiplied by the variance, $250,000. Divided through by the interest rate. Now, we said it was 0.05%. Now, think about it. 0.05% is the same as 0.0005, because a percentage is something over 100. Yes? You take that to the power 1/3. So, slot that into your calculator and see what you come up with. My calculation is that we end up with a spread of 7,970. $7,970. Now, that's all well and good. That is the range over which we allow the cash flow to move without us taking any control action. But of course, given that we have the spread, we would expect to do a few other things. For example, what is our maximum level? Or, if you wish, upper level? Well, the maximum level is simply going to be the minimum level plus the spread. So here, that's not exactly going to be too tricky. The minimum level we said was 25,000. We've just calculated the spread above, 7,970, and we end up with what? 32,970. Now, what does this represent? Well, this represents the maximum level that we're willing to hold of cash. Any more than that, we're suggesting, is inefficient. So if we hit this level, we will take out the difference between the maximum level and the return point and invest it in short-term securities. Another point that the examiner may ask is the return point. Remember, what we said was we would start with our minimum level. That has to be given. Plus 1/3 of the spread. So we have $25,000 plus 1/3 multiplied by a spread. What was that? 7970? And that means that the return point is 27,657. These are the key numbers that we're expecting to calculate. Shouldn't be too much of a problem, I hope. The key with Miller-Orr is to be able to calculate these, but also remember the key features underpinning the overall model. So just before we leave this area, to reiterate them. Features. First, it is an environment of uncertainty. By introducing the standard deviation or variance, we are reflecting some measure of dispersion around the mean. Secondly, we're looking to minimize two costs. One cost is the transaction cost, and the other cost is the opportunity cost of holding cash. Please remember this, because of course, if the opportunity cost of holding cash were to rise, you know, the percentage daily interest rate, we would find that the spread gets smaller. If it were to fall, it would get larger. And that's the sort of question that the examiner wants you to talk about. So, we're minimizing the sum of these two here. Beyond that, there's not much more we can say. We could easily see this as a 6 to 8 marker in the exam. And I think it's really quite straightforward, providing you remember that we're looking at daily interest rates and you remember that fiddle about standard deviations and variances. So we've got Miller-Orr. I will say it's very rarely come up, but your examiner specifically asked for it to be put in the syllabus way back when he joined ACCA as an examiner, so it must be expected to come up occasionally. Let's move on. When we look at the Baumol model, I can't get too excited about it. It's the EOQ for cash. Q equals the square root of 2 cod over chips. So all I want to do here is to illustrate what it is that it calculates in direct relation to the EOQ itself. So if we have the EOQ and we have Baumol, what is it that we're trying to get out of it? Well, okay, if you remember, when we looked at the EOQ, we wanted to know Q, CO, CH, and D. So, if we were looking at the economic order quantity, Q was the order quantity. CO was the cost per order. CH was the cost of holding 1 unit per annum, and D was the annual demand. Now, we should remember that from our EOQ, no problem there at all. What we want to look at now is how does Baumol differ? Because the idea behind Baumol is this. During the year, we are a net generator or user of cash. I would expect it to be a generator of cash. And as such, what we have to do is to take chunks of cash out of the business bank account and invest it on a regular basis. So, when we look at D, we talk about the net cash generated, or used if you wish, per annum. You know, the amount generated over and above that invested or used. CH. Well, this is the opportunity cost of holding cash. So it's like a holding cost. The only thing is it would be a percentage. The idea that if we have money in our bank account, we are foregoing interest that we would otherwise earn. CO, the cost per transaction. Remember the idea. We said that every so often we take money out of the bank account and invest it. This is the cost. And Q? Well, this is the amount invested per transaction. If we remember that, we've got something to talk about in BOML. I'm not going to get too excited about it because BOML figures once every 10 exams or something of that nature. So let's move on. Let's look at something that possibly the examiner's got more interest in. Let's now focus on the cash budget. To do this, maybe the best thing is to look straight at a question. Because the thing about cash budgets is this. All we're looking at are inflows and outflows. Given that we're looking at inflows and outflows, what we want is a basic pro forma to deal with the sort of complexity. Let's look at the sort of nonsense that may be given to us, and then we can go away and describe maybe how these questions have to work. If we look at a requirement here, prepare a monthly cash budget. You should include the business purchase and the first 4 months of operations following purchase. Well, that's fine. Looks straightforward. But let's just look at the overall question that we've been given here. The overall question has got loads of information that we're going to go through step by step by step. We have 1, 2, 3, 4, 5, 6, 7 major comments, each of which must be dealt with. And if you try and do this question as a single question, it's impossible. So my idea is simply to walk through it line by line, sentence by sentence, because any cash budget must be set up in that way in order for you to have any chance of passing it. So, as we go through the question, we are simply going to tick off each and every one of these points as we go. In fact, in the exam, I like you to have a yellow highlighter pen, because as you use something up, you can highlight it, and that starts to make you feel good when you realise that you've gone through half of the question and more. So, that's what we're intending to do. Before we look at it proper, let's just see how we may go about with this sort of nonsense. You see, whenever you get a cash budget, you must be given one thing for each month of the cash budget. And that one thing will be related in some way to sales. It will either be sales units or sales revenue. Some of you may have learnt in your previous studies that that's not surprising, because sales is the principal budget factor. All we have to be aware of is that it is our starting point. And the two classic workings that you are required to do here is 1, to get the receipts from sale, and 2, to get the payments for our material purchases. Now, there may be other things in the cash budget. There will be. But those two components on their own will be worth over half of the marks in the vast majority of questions. So, if we've got our sales, we have to follow instructions to understand the receipts. Shouldn't be too much of a problem. We have to make sure we can do that. Then we have to work the other way. If we know our sales in units, what we then have to do is to establish the units that we produce. Effectively, what we have to do is to work backwards through the whole operation to get back to the point at which we purchase and pay for our materials. So, if we have sales, what we want to do is to deal with our finished goods stock by adding closing stock and taking away opening stock. By doing that, we work from sales to production units. And once we've got to production units, then we can establish our material usage. The relationship between, say, the kilos of material going in and the units produced. Once we've got to our material usage, then we would have to add closing stock of raw materials minus opening stock, in order that we can work from usage to purchases. And once we've got purchases, then we want to look at payment. Now, there will be other things for us to consider. For example, we would also expect maybe labour costs to arise from production, another variable cost, and therefore payment for labour and things like that. But what I'm trying to get at is this. In most questions, if you can break the back of sales receipts and material purchases, you're going to score heavily. Or, to turn it another way around, if you don't break the back of these two elements, you're just not going to score enough marks here to interest the examiner. So, with that sort of idea, let's go back to the question that we have. If we're looking at the question, the first paragraph is all about the business purchase. And although we will have to consider it, I do not intend to look at that paragraph first. Remember, I said to you that the starting point of this question is going to be something that gives us information for each and every of the months. And what we see here is that we're given information for months 1, 2, 3, 4, 5 and 6. And that is the information that allows us to do everything else. If you notice, the information here is in sales terms. In this case, it's in sales revenue terms. So let's read note 1 and see what it has to say. Sales before discounts of a business's single product at a markup of 60% on production cost will be. Well, okay, I don't know what that markup is about. I think we'll find pretty soon. Presumably, it will give us a relationship between the selling price and the production cost. But we'll talk about that later. If we read below, 25% of sales will be for cash. The remainder will be on credit for settlement in the month following that of sale. Well, my view with anything like this is we take it sentence by sentence, line by line. So shall we stop there and prepare our working? If you notice, we've got 6 months' worth of sales revenue. And from that perspective, what we're going to need is 6 columns in our working. So we have the months numbered 1 to 6. And the one thing that we know so far is the sales revenue. In fact, this is the only piece of information that we know in terms of each month. So if we look at the sales revenues, we're going to take 96, 96, 92, and so on, and just slap it straight in there. 96, 96, 92, 96, 100, 104. Right. Now, given that we have those, what we now want to do is to understand what our receipts will be. Now, my view is that there's so much going on here, we do not want to do anything clever. Instead, we're going to do lots and lots of little steps that progressively get us there. I think this is quicker because each step in itself is not difficult. If we look back at the question, what was the first instruction we were given? Oh yes, 25% of sales will be for cash. So couldn't we simply say something like this? 25% of the receipts will be in the current month. If they're cash sales, the sales revenue will correspond with the cash received. 25% of 96 is 24. 96 is 24. 92 is 23. 96 is 24. 25 and 26. Have I done something stupid? Well, I probably have. Notice these two here. Do I really need them? Because remember, we only wanted values for months 1 through 4. A little bit of practice, if nothing else. Fine. So, 25% of current month. What else are we told? Going back to the question, the remainder will be on credit for settlement in the month following that of sale. Oh, shouldn't be too difficult. So, 75% will be, well, if they're on credit, they'll be 1 month later, won't they? I just call this month plus 1, yeah? And I suppose what I'm suggesting is this. If we're looking at the sales in month 1, 75% of the receipts will be received 1 month later in month 2. 75% of 96, what does that come to? 72? Yeah, as simple as that. Not as simple as that, not too difficult at all. So we keep on working. Month 2, the sales revenue is 96. 75% of that is 72. Month 3, 92. 75% of that is 69. 75% of 96, 72, and 75% of 100, I bet you, is 75. We're looking pretty good. I'm a bit concerned about this little chappie here. We have no value in month 1. And all I would remind you of is that in this unique question, we bought the company at the beginning of the month. And therefore, maybe the receipts from the previous months will go to the previous owner. Normally, of course, you'd be looking for a number there. So, let's go back. Reading on. Now, there are always going to be tricky bits in the exam. Please don't worry too much if you mess them up. You've got to get the easy bits right and you've got to keep on moving. What we see here is a discount of 10% will be given to selected credit customers. Now, if we stop there, the discount relates to the credit customers, so it relates to people 1 month in advance. Do you remember those +1 that we talked about before? Okay, don't know what sort of discount it is, but it relates to them and not the cash customers that you may expect. And secondly, it's 10% who represent 25% of gross sales. What do we mean by gross sales? Well, I suppose we're going back to the original sales that we have at the top of our working. Yes? So it's slightly complicated. It's terribly easy to get this bit wrong. Well, we do our best in the exam, don't we? You cannot sit there for hours contemplating what the issue is. You've simply got to get on and get something down on paper. So if we were to look at this sort of thing, what I'm thinking is this idea. We've got a discount. It's 10% of 25%. And if you do that in your calculator, I think it comes to 2.5%. But the one thing to remember is that it relates to gross sales. And I suppose what this means is that we're going to take it from that figure there, and it's going to dump into this point here because it's a credit sale. Yeah, slightly complicated, but who cares? If you get it slightly wrong, you lose half a mark. One of the key features about my technique here is this. I'm not expecting perfection, but if I nibble away at the question with lots of little computations, everything I do that's right is going to get a mark. And at least the examiner can see if I make a silly mistake. So, 2.5% of 96 comes to 2.4. Discount 2.4 and 2.3. I've decided not to do months 5 and 6 because I just don't need them. And hey, presto abracadabra, I have a key number. I've got our receipts. 24, what does this come to? 93.6, 92.6, and 90.7. Critical numbers, definitely worth 2 or 3 marks in the exam, an absolute must to get right. And all I want you to see is the methodical, step-by-step nature by which we've managed to achieve this. Well, okay, so we've got our sales receipts. Let's go back to the question. We dealt with note 1. Now, note 2. Production cost will be £5 per unit. Is there anything we can link that to that we've talked about already? Well, my view is this. Do you remember back up here, we were told that there was a markup on production cost of 60%? So if we've got our production cost and we've got our markup, we can get our selling price. Couldn't we simply say that the selling price is going to be 1.6 multiplied by 5? What's that? 8? Yes? 8, on the basis that what? We've got 1 representing the cost plus 0.6 representing the markup. And to me, that is absolutely critical. Because remember, the information up here was all given in revenue terms. If we know the selling price, revenue divided by selling price will give us the sales units. Right, so we've suddenly got an access point into the question. What else are we told here? Well, we're told the raw material usage and the direct labour cost. These are variable costs. And because they're variable costs, yes, we expect them to vary with the level of activity, the production. How do we play with the fixed cost? Well, the whole point is that it's fixed. We do not expect it to change month on month on month. But we may be using that pound somewhere later on. So, shall we just go to our working and establish what our sales units will be? Sales units. I suppose everything's going to be in thousands, and all I'm going to do here is to divide through by 8. You know, the selling price was 8. Therefore, 96,000 sales revenue that we have at the top divided by 8 is 12. Divided by 8 is 12. 92 divided by 8 is 11.5. 96, 12. 100, 12.5, and 13. So we have our sales units, critical, yeah? The sales units in thousands. Right, let's look at the next note. Remember, once we've got our units, don't we want to try and work towards purchases? And to establish our purchases, we need to know our production units, don't we? Let's read note 3. Okay, reading. Production will be arranged so that closing stock at the end of any month is sufficient to meet sales requirements in the following month. Oh, so the closing stock in one month is going to be the same as the sales made in the following month. Well, that shouldn't be too difficult. So let's just take that piece of information. Right, we've dealt with, you know, the early part, the first sentence, and just see what we can do with it. Do you remember the way I suggested that we deal with these things? If I may just tidy things up slightly. I said add the closing stock and take away the opening stock. What we're effectively doing is working backwards from sales to production, and that's the reason why we're doing it this way. And we're told that the closing stock is the same as the sales of the following period. So, for example, if we know that the sales are 12,000 in month 2, that must be the same as the closing stock in month 1. Simple as that. So couldn't we say that? And sales in month 3 will be the same as the closing stock in month 2. Sales in month 4 will be the same as the closing stock in month 3. Sales in month 5 will be the same as the closing stock in month 4, and so on and so forth. So it's not too difficult. We've got an established value for the closing stock. And of course, we know that the closing stock in one period is the same as the opening stock in the next. So the closing stock in month 1 becomes the opening stock in month 2. And we do the same for month 2 to 3, month 3 to 4, month 4 to 5, and month 5 to 6. Now, a couple of issues here. When we do this sort of thing, well, if we look in month 6, we're missing a value. Is there any way we can establish the closing stock for month 6? And the answer is no. So it's one of the features of these questions is that you tend to lose information at either end. And that's the reason why we're given 6 months of information in spite of the fact that we only need 4 months in our final answer. But I'm a tad more worried about the opening stock in month 1. I really would like a figure for that. So let's go back to note 3. A value of £30,000 is placed on stock of the finished goods which was acquired on purchase of the business. Right. So we needed an opening stock for month 1. And the opening stock for month 1 is now, today, this moment in time. And this is the time when we purchase the business. The only thing we have to be slightly careful about is this. We've got a value here in pounds, and of course we want it in terms of units. So if we read on, this valuation is based on the forecast for production cost given above. Oh. So what's happening here is this. That 30,000 relates to that £5. And if that's the case, couldn't we simply say 30,000 divided by 5, that gives us 6,000 units? Simple as that? Wow. It's all coming together. We have an opening stock of 6,000. And therefore, we're now able to establish what our production units must be. Again, everything's in thousands, just to make life a little easier. 20 plus 12 minus 6, 18. 12 plus 11.5 minus 12, 11.5. 11.5 plus 12 minus 11.5, 12. Keep on going, 12.5. Keep on going, 13. And of course, we have nothing for month 6. Don't push it. If it's not there, it's not there. So we've got our production units. Right. Okay. Now, what was the next point? We've got our units. We want to value our materials. Have we got anything that allows us to value the materials? Well, if we go back to the question, if you note up here, we know the raw material cost is £2.50 per unit. So we could say that the material usage is 2.5 if we want to value it financially. Okay. So that being the case, we've got our production units, fine. If we want our material usage, all we want to do is to multiply by 2.5. And if we multiply by 2.5, we get 45 we get 28.25, we get 30, 31.25, and 32.5. So we've got our material usage. Now let's go back to note 4. The single raw material will be purchased so that stock at the end of a month is sufficient to meet half of the following month's production requirements. Same old, same old. It's exactly similar to what we did before. All we have to do is to pick up on the right numbers. The following month's production cost will give us this month's closing stock. So, again, exactly as before, we're working backwards from material usage to material purchases. So we want to add the closing stock and take away the opening stock. So, closing stock is 50% of the following month's production requirements. 50% of 28.75, 14.375. 50% of 30, 15. And we carry on. 15.625 and 16.25. Oh, we don't have a figure here. Remember, we keep on losing them, don't we? Yeah? Okay. And of course, the closing stock in one month is the same as the opening stock in the next. Not difficult at all. So presumably, we just carry forward the closing stocks in order to slot in the values that we need. I do wonder whether there's any point in putting anything in month 5, but I'm a creature of habit. But we're still missing an opening stock for month 1. Shall we go back to the note and see what's what? Raw materials stock acquired on purchase of the business, 15,000, is valued at a cost per unit, which is forecast in 2 above. Okay. The only thing we have to be slightly careful of, it's not difficult, is please note that I've got everything here already in financial terms. So I want to take that 15,000 and slap it straight in. I don't want to do anything clever with it. So we've got our material usage. Add the closing stock, take away the opening stock. We can now establish our purchases. $44.375 and so on. Well, okay, we've got our numbers in. What we now want to look at is timing. We haven't yet established when this has to be paid. The final note in the question, just reading on, raw materials will be purchased on 1 month's credit. Well, if they're purchased on 1 month's credit, that's 1 month late, isn't it? Now, I don't know whether I bother writing this into my workings, but just so we have some masterpiece in front of us, 1 month later, 44.375. 1 month later, 29.375. 1 month later, 30.625. These are our payments. Interestingly, remember we've just bought the company. We're going to have no payments in month 1 because presumably we bought the stock or whatnot from the previous owners. Right, I've shown you the 2 core computations. And the feature about it is you must be methodical. If you can be methodical, you've got no problem here. But you've got to go step by step by step. Let's just look at it as a whole and see what we've managed to achieve with all of these steps. If we look at it, what we're seeing is that, well, we've got to get our receipts bit by bit by bit. 3 components go into establishing our receipts. We had to convert into sales units. We then had to deal with stock to get our production units. Then we had to establish our material usage. Then we had to deal with stock again to get to our purchases, and then we get to our payments. Step by step by step. But if you notice, by looking at each and every component bit by bit, we can get through a complex question. And each individual step should not be too difficult. At least that's my hope. So, we've got this far, but of course we haven't quite finished yet. Let's continue. What other information are we given? Oh, very nice. Costs of direct labour will be met as they are incurred in production. Well, that's fantastic. Please remember, labour is a variable cost. As such, we see in note 2 that it's got a variable cost of £1.50. And if they're met in production, effectively the cash flow is in the same month, all we have to do is to multiply the production costs, the production units by 150 to get our labour costs. So if we look back at our workings and notice I've virtually completed all of the workings I can do here, you may be inclined, or maybe not, to look at your labour cost. This is a cash flow. We're going to multiply it by 1.5. 1.5 multiplied by the production units. Note the production units here, across here. Okay? So, what have we got? 18 multiplied by 1.5. I can do that. 27. 11.5 multiplied by 1.5, 17.25. 12 multiplied by that, 18. And 12.5 multiplied by that, 18.75. Okay? So not difficult to call, and of course we could have slotted those straight into our final answer, but I just got excited. Right. We're virtually done. We've done all the tough stuff. And all we've got are a few other bits and pieces. But effectively, what we had to do in this more complex of workings, we don't have to do anymore. We've done all the tough stuff. Reading on, what else have we got? Well, let's just look back at what we've managed to achieve. Well, yes, the vast majority of this question has been dealt with. You could say we've dealt with all of this area here. And if that's the case, it starts making you feel a little bit happier. We've just got a couple of comments at the bottom. Oh, and this paragraph at the top. So this is not going to be difficult for us at all. So let's move on to comment 6. The fixed production overhead rate of £1 per unit is based upon a forecast of the first year's production of 150,000 units. Fine. This rate includes depreciation of equipment and fittings on a straight line basis over the next 5 years. Depreciation? Yes, depreciation is not a cash flow. And given that it's not a cash flow, we want to take it out. Where do we find these equipment and fittings? Well, it sounds like something that we would buy. If we look at the top paragraph here, we see that we purchased equipment and fittings to the tune of 120,000. Well, okay, so we've got all the bits and pieces. We just have to go and do some sort of silly working. Not too difficult at all. So we look at our fixed overhead. We know that the total cost is going to be 1 multiplied by 150,000. Yes, I'm very good at my 1 times table. 150,000. And all we want to do is to strip out the depreciation. So, the depreciation here. We're told that we've got 120,000 of equipment and fittings. No problem. And we're told that it's spread on a straight line basis over 5 years. So couldn't we just divide by 5 and we would say, well, depreciation is going to be 24,000 a year? And if that's the case, we get 126,000. That is our cash flow per annum. Unless we're told otherwise, we assume that the fixed cost is the same each and every month. So, to get it per month, all we have to do is to divide by 12. What does that come to? Is that 10,500 per month? As simple as that? Well, okay. So we've dealt with our fixed overhead. And then we have a very similar requirement to finish up with. Selling and admin overheads are all fixed and will be 208,000 in the first year. These overheads include depreciation of the delivery van at 30% per annum on a reducing balance basis. All fixed overheads will be incurred on a regular basis, with the exception of rent and rates. 25,000 is payable for the year ahead in month 1 for rent and rates. Oh, it's the same sort of nonsense. We've just got to be careful of rent and rates as well. Delivery van. Well, if we go to the top of the question, we find a delivery van somewhere. We've got a delivery van purchased for 15,000. Okay, well, given that it's purchased this year, the fact that it's reducing balance basis is not going to be a problem. Let's just mess around and sort these numbers out. So what have we got? We've got selling and distribution overhead, and we know that the total is 208,000. From this, we want to offset depreciation. We are told depreciation is 30% on a reducing balance. We had 15,000 multiplied by 0.3. What's that? 4,500? And that means that we have 203,500. That's our cash flow. From that, we want to offset rent and rates. Because remember, rent and rates are specific to the first month. So we take those out because we're going to slot them separately in the first month, and we end up with 178,500. That is the cash flow per annum that we're after. Now, given that we've got our cash flow per annum, we want it per month. If that's the case, we divide by 12. Dividing by 12, we end up with 14,875, and we slot that into each and every month. So we have all the numbers, and all we have to do now is to put them into a final pro forma. And I'm hoping this isn't too bad. I think it could be a lot worse.